We're widening out the lens and taking a look at the global picture for 2023. As our next guest says, a global downturn can be in sight next year, and the road ahead for stocks will be bumpy. BNP Paribas U.S. economist Andy Schneider joining us now. Andy, good to see you here. You mentioned in the note you guys sent over to us, stocks will be on a bumpy road. How bumpy, you think?
Yeah, well, thanks for having me. So, for stocks, in our view, we kind of think this is a bifurcated journey in a way. So the first leg down, if we look at the PE multiple, is really the P coming down. But for us, the next leg down is going to be the E. And this kind of links to our economic view, where we think we're headed for a recession. And we think it's going to be about 2 quarters. But by Q2 next year, we will be contracting in the economy. That's going to flow through to earnings. So that E is going to come down. And we don't think the PE multiple is going to go up with it. So even if we keep that constant, that means the PE has further down to go.
Okay, but has the bottom already been set in? Are we going to retest the October lows, or is this a kind of breakthrough of those October lows that you think the equity markets might actually reflect what that risk of a larger or mild even recession might look like?
No, we think we're going to go lower. And, when we look at kind of consensus earnings estimate, we think they're still a bit too high. They're not really pricing what we think is going to be a real recession starting next year. So, we think as we start to see more weakness in the data as we get in, those earnings estimates should start to re-rate lower, and you should see the stock, the overall market kind of retest those low and, in fact, break through it.
Hey, Andy, what's been so remarkable about this period of time is that consumer spending has held up pretty well. The patterns have shifted, right? We were just talking to a travel CEO who's still seeing a lot of demand, but we've seen things like electronics on the wane a little bit. If we get into the beginning of next year and we're looking at what is effectively a stagflationary environment where the economy's contracting, but there's still hot inflation, where are we going to see consumer spending start to crumble? Where are you going to be watching?
Yeah, it's a good point. And I think, for us, for the consumer spending side, there's like 2 things at play that are really important. Number one, this excess stock of savings, which is still present and still there. And in our view, it's about 1.7 trillion. So that's going to keep consumers being able to spend for the balance of this year and as we get into next year, too. But the difference, I think, is hiring and payrolls. And right now, hiring's really strong, but we're seeing some cracks in it. And as we get deeper into next year, we think that hiring's not only going to reduce, but by the mid-year, we can even see some negative payroll gains. So that's going to filter through into consumer income, and it's going to filter through into confidence. And all the while, that stock of excess savings, it's going to get lower and lower. So all of a sudden, I think we're going to have savings kind of acting as a rocket, and it's going to act more as a cushion, and people are going to pull back, and you're going to see more weakness in consumer spending.
And then let's just talk briefly about the Fed, Andy. What will be the trigger for the Fed to pause? Is there like a particular level of CPI that you're looking for example?
Yeah, so we think we're going to get another 125 basis points a hike. So we see a pause at 5.25%. And to get that pause, what the Fed's looking for is they want to get to a sufficiently restrictive level of rates. And for us, the key in that is we are going to see a little bit of slowing down in inflation and also slowing down in the economy. And I think for the Fed, that's going to tell it, okay, we're at a very restrictive level and we can, take our foot off the acceleration a bit. But what's really important, and this is something that I think Powell is going to emphasize later today, is part of that tight monetary policy. It's not just the level, it's the duration spent there. So even when we get to 5.25 next year, we think they're going to hold there all through next year, even as the economy, slows and in fact contracts. So a pause at 5.25%, I would not call that a pivot, especially because we think they're going to stay there all the way through next year.
All right, that speech coming at 1:30 p.m. Eastern Time from Fed Chair Jay Powell. BNP Paribas U.S. economist Andy Schneider, thanks so much for taking the time here